Good evening, everyone. Time for another silver update. Now, this is the monthly chart of the Dow 30 Industrial Average provided by netdania.com. You can click on the link below. And this is the long-term view, and that's what we want to be looking at because we're going to be looking at a long-term view of the economy here. And you can see that the MACD down here has turned down. Now, it's not like the last two that we had. This one was the dot-com bubble, and you can see once it crossed it, pretty much that was it. It was done. Now, it took a long time here. You can see that it traveled down for quite a ways before the market succumbed right there, which is the equivalent of there. On the other hand, the 2008 financial crisis, as soon as this turned down here, we pretty much got the downturn. We just went straight down. This one is more rolling over, but it could at any point take a decided downturn. It definitely is rolling over. It has crossed. So we're looking for the next financial crisis. We've gone a long time. You can see it's one of the biggest runs we've had compared to the past. Maybe only rivaled by this entire dot-com thing. So what's behind this? Well, I think that there are definitely warning signs coming. I want to take you over to this Gordon T. Long article. This is published on the 14th. Are banks shutting down lending? IMF warns regulators to brace for global liquidity shock. Now, the IMF, these are the same people, and the Fed and all the rest of these people that for a long time have told us, well, we see growth, and you know, when you see these people stop and turn on a dime, this is what this appears to be to me. So before we get into, he's assembled a really good number of charts here. And we want to go through these and look at these. But before we do, I want to take you over to that story. This is the story. This is the Telegraph. And you can see that that's April 15th, right there, tax day. And the IMF tells regulators to brace for global liquidity shock. Financial engineering that preceded the last two financial crises is back. International Monetary Fund warns. Now, I'm going to show you when we look at these charts, it's not them seeing something coming and warning. It's them turning off the money. It's just that simple. And we're going to see it in the charts. But let's read what they say in the propaganda press. An illusion of liquidity has beguiled financial markets across the world and spawned some of the worst excesses seen on Wall Street in modern times, the International Monetary Fund warned. Now, let's take a look at that. Look at that language. An illusion of liquidity. Was this liquidity elusive? Did this liquidity not exist? Is this money that never really existed? Is that what they're telling us? Because this stock market performance doesn't appear to be an illusion. This would appear to be quite real liquidity. Or is the IMF about to tell us that this money really didn't exist? Investors are borrowing money to buy shares on the U.S. stock market at a torrid pace and are resorting to the same sorts of financial engineering that preceded the last two financial crises. Quote, margin debt as a percentage of market capitalization remains higher than it was during the late 1990 stock market bubble. The increasing use of margin debt is occurring in an environment of declining liquidity, said IMF in its Global Financial Stability Report. Now, that's ridiculous. We all know that margin debt was not what was behind the dot-com bubble. That's silly and insane. And we know as well now that it's not margin debt that is behind this stock market bubble. The general public isn't even participating in this market. How could it possibly be margin debt? The Federal Reserve, on the other hand, has its own trading accounts in all of the futures brokerages. They actually have discounts. It's the Federal Reserve. So they're spinning this thing. This seems to be a clear indication they're getting ready to turn off the financial spigots, and they're setting up their scapegoats. But to keep it's clear, and keep it clear in your head, they are the ones who are going to turn off the money. If there's a crash, it's their fault. If the markets collapse, it's the IMF and the Federal Reserve that caused it. It's not margin borrowers. Quote, lower market liquidity and higher market leverage in the U.S. system increase the risk of minor shocks being propagated and amplified into sharp price corrections, it said. The report said there are clear signs that underwriting standards are deteriorating in a pervasive search for yield. And I'm not going to go further into this. This is just straight IMF propaganda. And it's incredible that everybody doesn't see right through that for what it is. But let's return to the Gordon Long article, and let's examine these charts and try to figure out if this is really starting to happen. In other words, and here he's talking about the BIS. There's another one of the evil players of this gigantic global Ponzi scheme. They're the ones who have enabled this to happen. And now they're going to try to turn around with the IMF and claim that, oh, well, this is out of hand. We're warning you. When in reality, we know they've given the order to the Fed and to the banks to turn off the money. Now, this first chart isn't that shocking, but this chart is one that's been making the rounds on Zero Hedge, on all the sites. And this is credit application rejections. Look at that chart. That is the biggest spike on record. Now, this is the most telling chart of all these charts as well, because what does this chart tell you? Well, look at the last financial crisis. You can see that we had 1 month in 2000. Actually, it looks like, are these 12? Yeah, these are months. You had 1 month there. You see that? January 2008. And then what happened? They turned off the money. This is not rocket science. This is credit rejections. Okay? So it's not like all of a sudden in late 2007 and through the summer of 2007 and in the fall of 2007, people were just in fantastic economic shape. Their jobs were great, their wages were great, they were making lots of money, and they were looking forward to the future, and everything was just gung-ho. All the way up until the beginning of 2008, and then all of a sudden, boom, everybody's finances were terrible. They couldn't qualify for any loans because they didn't have the job, and all of a sudden, we know that this stuff does not turn on a dime like that. The only way it can turn on a dime like that is if they turn off the money. And of course, we know the reason for their spin. They're going to try to claim that it wasn't them that did it, but we know it was them that did it. And now look at these charts here. The first spike for the down month in 2015 rivals everything but the top 5 of the height of the economic crisis. But this next month here is the biggest spike, bigger than anything even during that crisis. It looks to me, folks, like they're turning off the money. We'll read a little bit from the Gordon Long article. The $72 trillion global shadow banking system is built on the tenet of borrowing short and lending long. When the short-term paper borrowing in ABCP suddenly stopped in 2007. You see that? Suddenly stopped. The credit markets panicked and counterparty risk took hold. As Ambrose Evans Pritchard reports in the UK Telegraph, a third of all sovereign bonds in the Eurozone now carry negative yields. This is causing havoc for money markets and for the life insurance industry, which has locked into commitments stretching out for 35 years that are becoming untenable. You think? They've made commitments to pay people these annuities at these guaranteed interest rates, and yet there's negative yields on what they can invest in. Quote, a prolonged low interest rate environment will pose severe challenges for a number of financial institutions. Weak European mid-sized life insurers face a high risk and rising risk of distress. The failure of one or more mid-sized insurers could trigger an industry-wide loss of confidence, is said. The industry has a portfolio of 4.4 trillion euro assets in the EU, with high and rising interconnectedness with the wider financial system. A large mark-to-market shock could force life insurers into asset reallocation and sales that could engulf the financial system, it said. Commercial lending has been steadily approaching contraction. Here's the chart here. You can see commercial lending. Now I want to show you one more chart. Here's another one showing things turning down. Assets losing their shine one at a time. Here's cracks in credit card usage. You can see that's starting to turn down like it did in the last financial crisis. Here's the increase in credit is, you can see it's the student loans, auto loans, and then here's an S&P 500 forward earnings. But this is the chart that is the real shocker. I wanted to show you this chart because this one, I was not aware of this at all. This is consumer credit growth since the cycle peak. And you can see that it has the beginning of it back in 2008. And then you can see a small rise happening in this since 2008. But it's at the beginning of the financial crisis when this thing really takes off. Now, this red line, which you can barely see because it just matches the baseline, and that's what this arrow is doing here, is privately owned. This is privately owned consumer credit growth, okay? It's flatlined. You see that? Now, this is government-owned credit growth, okay? You can see that, and that's what this yellow is. That's describing the blue. It's gone from a low of less than 1%. I think that's right, yeah, around 1 or less than 1% in 2008 to all the way here up at 8%, okay? So all of this growth, this is government growth. This is credit via government backing. So once again, we see here that if things crash, if the spigots get turned off, if the cycle suddenly turns down, we know who did it. It's the government that did it. It's the IMF that did it. It's the BIS that did it. It's the Federal Reserve that did it. But do you see how hard they're trying to tell you that it's someone else? It's the public. It's something, it's not them, but it is them. And it looks to me like they're getting ready to turn it off. So it's time to get ready. Now, I wanted to take you to one of my favorite coins here. And the reason I'm doing this is I'm trying to make a point about this. I've had a lot of people criticize me for promoting what are called semi-numismatic coins. Now, for me, when I say semi-numi, I'm talking about a coin that is just a little bit more expensive than a bullion coin. The current products that are comparable to this coin are about $2 over the eagle and the maple, although sometimes you can find them close to that. So if you're talking about the eagle and the maple, you're talking $2 to $3 above spot. You're talking about Perth, your Lunar Series, you're talking about $4 above spot. So we're talking anywhere from an extra $1 to $1.50 per coin, per ounce of silver. Now, a lot of people have told me for many, many years, and I have disagreed with this for the entire time, that the best thing you should buy is the most silver for your money. Now, I totally disagree with that, and I'm going to use this, my favorite coin, to demonstrate that. Now, I'm willing to put the offer out here. I don't actually have the money, but I would find the money if I had to. And I'm willing to put the offer out that I'm willing to buy this coin. You can see 300,000 of these coins, and I've got quite a few of these coins. I'm very glad I got these coins. I'm willing to buy this coin right now at double the spot price of silver. So silver's, we'll just say $40. So I'm willing to buy this coin for $40. Pretty much all takers. Anybody that's willing to sell me this coin for $40, I'll be willing to buy it. I'd have to make some arrangements if it was a lot of them. Probably have to partner with maybe some of the members on the site to get that done. But I'm totally confident in the value of this coin. I'd be willing to buy it for $40 an ounce. Now, the question is how many people would sell it to me? I don't think any. I really honestly, I don't think anybody would be willing to sell me this coin for $40 an ounce. And it's easy to prove. If you can find them, go ahead and give me a holler. And if I can't buy them all, I'll arrange to, I guarantee you, I can arrange to have somebody buy every single one of these coins. That's going to be 300,000 coins. Now, I know the members have a lot of the recent issues, but 300,000 coins is not that many coins. You could have easily, when this coin came out, I think the cheapest I ever saw this coin was 25 bucks. So you could have spent $25,000 and you'd have 1,000 of these coins. And, you know, that would be 1/3 of 1% of the coins that are out there. So that could have been just about anybody who did that. I personally think that these coins are in very, very strong hands. I don't think anybody who owns this coin is going to be willing to part with it. Now, I told you about why I thought so at the time. Of course, it's the year of the tiger. China is the tiger. It has a Chinese symbol on it. I've talked about the lunar series now. Not just the Chinese mint, but the British mint, the Canadian mint, the Bavarian mint. Now they're all starting to do lunar coins. They're giving a nod to the Chinese. So this for me is proof positive. The fact that I'm willing to buy this coin for twice the spot price of silver. And I can just about guarantee you that nobody is willing to sell it to me. And we'll talk to you next time.